Okay, welcome to another video in this video series I have called Planning for the Week to Be. If Saturdays are for reviewing the week that was, that means that Sundays are for planning the week to be. Next week will be CPI week. So today is August 9th, 2026, and so we'll be planning for the week to be ending August 14th. So last week was NFP week, and it really revealed a lot about the character of this monthly candle that just began last week, the August monthly candle that we're in. And so I haven't really, I don't think I've been doing my due diligence as much as I should have been, because I haven't really seen the big picture. But now that I'm I'll show you from a monthly perspective to the weekly to the daily to the 4 hour, why I'm getting bullish on USD CAD. I'm sorry, I'm bearish on USD CAD in forex terms, but I'm bullish on the Canadian dollar. And this also goes for the Australian dollar, the New Zealand dollar, and then the euro and the pound, I believe, will also have lots of good long opportunities. And then I also want to look at natural gas. Part of the reason why I want to look at natural gas is the seasonality of it. Here we're heading into mid-August, so this is kind of a seasonal turning point for natural gas futures contracts. And I want to look at the technicals behind that from the using the 2023 model. So let's jump over to Brave, and I think I'm just going to do the rest of this video just kind of popping around in Brave. So I'll try to go in that same order that I mentioned, between the dollar CAD, the dollar the dollar CAD, Aussie, Kiwi, and then EU, GU, and then finally finish up the video on natural gas. So this is actually a 2-month chart, and this is kind of like what I missed in my analysis last week. Like I kind of knew how I wanted to play NFP, but I wasn't really like thinking about it in the higher time frame context, which is definitely a mistake. But anyways, moving forward, now I have a much better perspective on where I believe price will be heading. So we should move this up to there. So if you're looking at this as a 2-month time frame 2023 turtle soup model, you can call this up close candle, or actually this one works too, this as the origination candle. And then because that's the candle that we essentially like treat as a swing high, even though it's not really a swing high, I guess you could. Anyways, we're digging. Actually, yeah, treating this as a candle, because then you could say we dug into this and then we hit the breaker. But anyways, this is candle number 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and on the 9th candle, so that's actually not 10 in terms of accumulation into peak manipulation. This would be the final candle. So the peak manipulation entry actually happened here, at the in that wick there, and then we get another chance to be above this key level. I'll kind of zoom in and I'll show you where how I got this key level there, and then now we're actually distributing lower, and every single one of these candles take 2 months to play out. They're 2-month candles, and this one started in July. So we're looking at till the end of the year in terms of the active distribution phase, to allow us to trade down into this 1.35 level in CAD. This means that CAD's getting stronger. And even below. So because I'm looking at this and I'm looking at this rising trend line liquidity, and I'm thinking that we are going to hit our liquidity low point in Q1 of 27, and we're going to have some sort of episode. And we could even stall in and around the U.S. midterm elections in November. But I'm thinking that market makers are going to want to run these currencies higher, higher in terms of the actual value of the currency versus the dollar, which in this chart means CAD going, this means USD CAD going lower, right? But anyways, they want to run the currencies up in value, appreciate them as much as they can before whatever liquidity event is planned for the first half of Q7, the first half of 2027. So H1 2027 or even H2 2027. That is essentially like a pre-coded. It's on the 65-month global financial liquidity cycle that Michael Howell talks about. I'm a big believer in that. I've seen it play out a few times since I started trading. So, including the 2022. And if you look at where CAD was in November of 2022, CAD was stronger than a lot of the other currencies in that it obviously like had this really dramatic run, but into some like, pretty uncomfortable, periods of weakness versus the dollar. But 2022 for CAD was nowhere near as punishing as 2022 was for the pound and the euro, with the euro going, below parity, and the pound making a really honest run for parity, like scarily close. So anyways, I'm thinking that the market makers are going to want to run these currencies up as much as possible before this mini little, I don't know if it'll be a mini crisis, but this crisis that we seem to be tilting towards. So back to the analysis at hand. So July was the first month. We'll go to the monthly chart now. We can think about this in terms of monthly. Yeah, July was the first out of 6 distribution months, and July actually gave us a pretty good run. So if you think about this as happening linearly, with the end of the year 2027 being the target. So you'd expect 1/6 out of every, you'd expect if it were perfectly even, which it never is, obviously, you'd expect every single one of these candles to cover on average 1/6 of this vertical range to stay within like a linear envelope, let's say. And July satisfied that condition. And here we are in August after NFP, and CAD is still trading lower very much. So there's only been a quarter of the amount of time that's elapsed in August, and the August candle is already looking really sufficiently bearish. So let me show you why. We'll go to the weekly now. Let me show you why I'm fairly confident that CPI for CAD and for all these currencies is going to be bullish. In other words, for USD CAD, it's going to be bearish. but in other words, and this is in macroeconomic terms, you could say, well, we are due for a downward surprise in inflation growth, and that's going to cause more conviction in a dovish Fed policy tilt. The relative perceptions of monetary policy, they're going to shift, right? So Um, I'm fairly certain from a kind of a going from market making down into what is the going to be the quote unquote surprise on Wednesday morning at 8:30 a.m. Eastern Standard Time for the CPI data release. Um, I could see earlier in the week trading up into this, or maybe even pushing lower, and then like Wednesday Asia session, just like kind of like having a little, kind of a DXY resurgence and trading back up into some internal liquidity, obviously. But come 8:30 on Wednesday, we'll go to the daily chart now. Come 8:30 on Wednesday, I'm expecting that to trigger a pretty violent downward move into some key levels. So for CAD, I would be watching this one spot 339 round number, and here within the 50% of the range is a weekly opposing fair value gap. So one of the things Romeo talked about in 2023 was to be watching, which basically means like put your eye emoji. If you haven't got there yet, look for in the equilibrium part of the range, which is the 50% fib, look for an opposing fair value gap on more or less the signal time frame. So if we're looking in a 2-month range, then you'd expect between 1 and 2 weeks. And so there's even a bigger 2-week fair value gap there that we're looking to stab into. But the 1 week time frame refines this a little bit more, and we might just blow past it into this down close candle, into this, perhaps it's this wick, this kind of like opposing former potential breaker block, right? And then we might retrace back up and trade into this as an entry, because remember that if model number 1 entries happen in this part of the curve, right, then your second chance is to get a to wait all the way for like the breaker, or if it's more aggressive, to hit a fair value gap, maybe a balanced price range fair value gap on the opposing end of the range. So yeah, so I'm looking to be bearish this cross until we're essentially well past here, and then reevaluating. And then so yeah, that was CAD. Now we'll go for Aussie. Aussie's got the same setup. So we'll do the higher time frame drilling down into lower time frame. So for Aussie, it's not resolving on a 2-month time frame. You could say that it's probably even less. Yeah, it's Aussie is actually attractive because Aussie's looking to gain a lot of ground in Aussie terms, relative to its previous price action in a very short amount of time. So relative to CAD. So Aussie has this setup here where there's an SMT with the Kiwi, so we can treat this candle as the peak manipulation. And so with a 2-week, actually, yeah, that's interesting. So we've already kind of distributed because we're already doing our 1, 2, 3s. Interesting. So Aussie's almost giving you a different read than in terms of like taking its time. But yeah, I'm bullish. I'm still bullish on Aussie, though it's not quite conforming to the model as much. Actually, yeah. So if you treated, oh right, okay. I think I'm just like seeing this a little bit Um, so yeah, so if this is the origination candle, though it's not quite a swing high, so it doesn't really fit the model all that well. Um, we don't really get, yeah. Let's look at the kiwi really quick. Maybe the kiwi is more of a discernible. Yeah, so the kiwi gives you a much more discernible, like you know, I'm the way that I'm handling the 2023 model gives you a little bit more of a discernible read. Where if this is the origination candle, 1, 2, 3, 4, 5, 6, 7, 8, 9 on the monthly chart, right? So eight right here. That's your peak manipulation, and then and it dug into the this becomes the order block, like the wick of this candle becomes an order block that is a classic Romeo order block because it's got the bearish FVG. So you've got order block, FVG, you dig into it, and then the next 2 months of distribution should get us here and even past there. Because if you zoom out a little bit, there's probably other models at work on the even higher time frames. In fact, I think that's why I didn't really see Aussie as clearly. I think I actually need to go to like the quarterly or maybe even a yearly for those. Yeah, 6 months. Yeah, and so there's, it's interesting because with Aussie and the Kiwi, how, yeah, it really is their relationship to the so macroeconomically speaking, they're within the whole Asian halo with being a vendor economy for China, commodity supplying the quote unquote factory of the world. So it would be, it's interesting because China is definitely giving you push pull as far as they're definitely easing liquidity and they are a source of deflation rather than inflation, and they're really trying to keep their growth targets, but they're having some pretty heavy lifting. So yeah, it's going to be interesting to watch. But as far as like going down back to the weekly, you get the same sort of dynamic where this range, which is on a lower time frame admittedly than CAD, has its right around the equilibrium point, has a fair value gap. So if CAD blasts past its key level, its equilibrium, you'd expect these two currencies to do as well, and then maybe in the following week of August, so the week beginning on the 17th, we might have a pretty rangy candle with some sort of surprise to get us back into this opposing fair value gap to help us, to give us an entry, especially if the CPI move forms a bullish weekly fair value gap. So it might even be the last week of August, to be honest, because it takes a few candles to form a fair value gap, right? So if next week is a really bullish candle, then you have the following week, the third week of August, being perhaps an inside bar, and then the last week of August, starting on the August 24th, could be that little bit of a retracement, that stab towards the internal liquidity, especially if this is a BPR, because these candles have actually been fairly well covered. Like, this is very kind of pause CRT looking price behavior in terms of the long wicks with no weekly fair value gap forming. CAD, however, had same dynamic in CAD, like a teeny tiny weekly fair value gap that was immediately filled the following week. So yeah, that's my bias. That's my bias for sure. So yeah, we did Aussie, we did CAD. I'm gonna just keep rolling forward. Euro and the pound are late to this rotation that's happening. And again, with the euro and the pound, CPI looks to be very bullish. It I don't see, I guess I should, like, I guess I'm going to make my final decision on CPI, like, I'm forced to, essentially being a scalper, but that exact morning, I'm going to make my final call on CPI. But just looking at it on a Sunday morning and trying to plan the week to be, I really see a lot of potential for continuation into this equilibrium point. It's almost like the way you can think about it is like two parabolas. Like, there's a parabola into the equilibrium point, then there's a chance for the CRT to kind of like fail halfway through. But when you have that retracement at the equilibrium point to the bullish continuation, another parabola, right? So you're expecting your quickest delta, like, which is your change in price over time, to happen in this leg that we're currently in. And so I see CPI as like the catalyst, like the fuel to fuel that move. There's no, so this bearish FEG on the opposing range is before the equilibrium. So that has a chance of like being when I was talking about BPRs that like rip through, a bullish fair value gap and a bearish fair value gap in the same price range. That little fair value gap has potential for that as well. I would actually look to this potential bearish order block as the thing that you could, we might trade past it, but then when we have our period of retracement, then that could be the springboard as a breaker, right? So in other words, because price tried to remove aggressively down, and then we got a bullish CRT, and then we hit our it's kind of that A to Z pattern. That is a breaker, right? And so that's that elevated breaker in the range that if we blow past that, we can use that as a reversal zone for later on in the premium part of this range. So yeah, pound is giving you a much different view than the euro. And actually, you know what? Let me do this before I move on from the euro. And I really appreciate your patience with me here. The euro, I mean, look at the bottomless candle that we took out. I think I pointed this out last time. I hope I did. But anyways, if that's 13 bars, right? So the euro is again giving you that 2-month model, which is projecting bullish FX until the end of 2026. So we stab into the opening of that candle. Yeah, I think I already had this marked out. I hope I did. But anyways, yeah. So it's the same model that you saw in CAD, but obviously inverted, right? And so that's why we're confidently bullish. This is a potential order block, though no FEG, and where we are as far as overall, it would make sense to try to see price going even higher. Current crises very rarely repeat themselves. Like if the bottom of 2022 was a sovereign debt crisis, we're having something different than the sovereign debt crisis. Like, the great financial crisis of 2008 was real estate. The NASDAQ crash of 2001 was tech, right? Like Web 1.0. So, we pivot. History rhymes, but it never repeats itself, right? Especially not one right after the other in successive. So like, if you go back to 2001 in these currencies, 2001 was obviously like a liquidity low point. The euro had just been launched, so that's not really a fair comparison. Yeah, so we might need to even go back on other charts. I just want to look at CAD. What was CAD doing in 2001? Yeah, so CAD was extremely weak in 2001 during that low that period of low liquidity. I mean, the Asian financial crisis and then the fall of LCTM, long-term capital management. Getting back into the ancient history here, there was a hedge fund that had these derivative positions. They were like trying to play Latin American currencies, and they were trying to play the ruble, and so that's interesting that was a weak point. But yeah, I'm thinking, yeah. So that is the euro. That's what model we're currently in. We're in the distribution phase of this 2023 model, and then the pound. Obviously, I think we had an SMT here, and so the pound. Let me see if we can see a little bit better on the monthly. So if that's like an SMT, yeah. So the pound, we're on a shorter time frame. So if that's the origination candle, 1, 2, 3, 4, 5, 6, 7, 8, and then you get that SMT. So the pound is you're distributing a little quicker. And looking to take out these highs, not before the end of the year, but within the next 2 months, which is really exciting. So into Q3, before the midterms, right? So by the end of September, you're looking to take out that 1.38. So that kind of favors the pound as far as like, if you're only trading the pound or the euro, if you've chosen to specialize between one or the other, this dynamic where the pound is on a shorter distributional time frame favors the pound between those two. I personally, I think if I do forex trade, and I will because of the CPI and just like the macroeconomic implications, I'm going to actually favor the CAD. But I'm very flexible as far as I haven't really locked myself into one pair, or pair of pairs, so to speak, which is the advice that Romeo gives to novices, and I definitely respect that. And I really, I think I could, as I do more Romeo analysis and progress further into my trading journey here, I think there could be a period of distillation where I stop looking for crude, NASDAQ, these like one-off opportunities, and I just kind of stick with the bread and butter, stick with the guns, and trade pause CRTs and trade distributional legs. So yeah, so the pound doesn't have. This is the weekly chart in the pound. So it's far more of an intense consolidation into this distribution, which, if markets act like coiled springs, then the pound is obviously going to have a much more forceful distribution into what is definitely a lot more of an LRLR type of framework than you see in the euro. You see LRLR in the euro, but there's definitely more. It's definitely going to be more of a gentle. I could be wrong, but that's what I see from looking at these, just to compare the pound to the euro. So with the pound, with this being the bearish range, the equilibrium point, we're at or above the equilibrium point. In other words, we teased actually, so if we're on monthly, so actually we're above. We're above the equilibrium point. Depends on like which one you use, right? So let me go back to the monthly chart real quick. So yeah, no. That's if that's the origination candle, then that's the low, that's the high. Yeah, we're already above the equilibrium point with the pound. Interesting. Man, talk about mixed signals. Because I always have a little thing in the back of my mind like, where are we, you know, but yet look at what happened when we hit the equilibrium point in the pound is we get this mid-July like freak out, which forms this order block. So, I think you could pretty safely say that you could. I mean, we even hit the 618, right? We hit the 618, and then we have that violent retracement, which is definitely a divergence. The pound has new leadership as well. Oh, sorry, not the pound, but the England, the UK has new leadership as well, which I think is pretty bullish, just as far as optimism and like the whole product life cycle of a political administration or a political regime. But anyways, yeah, we're on the upward end of the curve with that. So yeah, the pound could springboard, which it already kind of did. NFP was definitely a springboard off of this order block. So if you go to the lower time frames, that's exactly what we did during the NFP week, where we look to, yeah, it was so choppy, like, and there's still so much liquidity too, which is crazy. Oh man, so like, yeah, the pound is definitely giving you a little bit of a different picture, just as far as like indecision. But it could be one of those things where we just all of a sudden explode out of a range without too much, and this was that like middle of July retracement that I mentioned, which in and of itself was a model, which is really cool, which has played out, I believe, right? So if you look at this as the origination candle, that's peak manipulation, 18 bars. It's 18 into 6. So 6 days. Didn't even get us to NFP. Already, so I'm just going to look at NG really quick. And then I got to go. So NG is really exciting. This might not be the analytical framework, though. I mean, I'm looking at the 8-hour chart of what happened after NFP. And we formed a bullish fair value gap after having sunk into this Romeo order block. So like if this is a Romeo order block, we and why is 8-hour important? Well, you look for an 8-hour signal to get long on a 2-week model. And we got the 2-week model in play. So in other words, if this is the origination candle 1, 2, 3, 4, 5, 6, 7, 8, 9, then, and which that is itself a 2-week order block. Would not maybe not a classic order block because you don't have a bearish FEG yet, but at least on the 2-week chart, which is a lot to ask. That is a definitely a potential for reversal higher. Which would be in line with if CPI was soft and Fed is dovish, that juices commodities, right? I mean that's essentially a signal that commodities there's slack here, and that you can start to appreciate more to fill in the slack to get price back into a better longer term equilibrium with. But anyways, looking at seasonality in natural gas, it's one of the most seasonal assets, right? Because it's used as heating, so it's always in mid-August, right? Here's mid-August 2025. We have a model higher. Here is mid-August 2024. We get a little baby model, right? Here is mid-August 2023, we get a little baby model, right? So there's seasonality on your side. You have a tailwind of seasonality when you try to go long natural gas in mid-August. So that's why I was excited to see that development with the way it reacted to NFP. And you got to think data centers. You got to think the Ukraine war, Europe's consumption. This is the Henry Hub contract. So this is like kind of US centric. So yeah, and it's this, if it's just this idea of like, if everyone's looking for substitutes because they're scared of crude shocks, then natural gas can be, not is a substitute, but it can be used to produce electricity. It can be used to, so yeah, there's, I won't get into like fundamentals, but yeah, really interesting chart. I just thought I'd zoom out a little bit to show you guys. Like the little Venezuela scare. It's just like, wow, like, my gosh. Talk about a surprise. But like, like even though that's a bullish up close candle, like that's very bearish, right? Because then we pushed down to the lows. But then aren't we kind of due for a pause CRT, higher? Especially given the trajectory of money moving out of the financial markets into the real economy in America as America reindustrializes, and that the fuel of reindustrialization is natural gas because we produce way too much of it. We're an oil exporter, and then we use it for, we're going to plug it into robotics. It's going to be like the, we're not at, we can't like build big solar farms everywhere. Like, we have to use, it's like Germany. Like when Germany ran out of natural gas, and Germany right now is where the developmental capitalists in America want the US to be in 40 years, right? In terms of reindustrialized. And when Germany ran out of natural gas in 2022 and 2023, they literally had to shut their factories down. So we'll go back to 2022 and 2023 in natural gas, right? So like natural gas, it's like this long-term play, obviously. It's a pause CRT, right? Like this entire leg from, we'll call this a down close range, from this high to this low. I'm not saying this is like definitely the low, but it might be the low. I'm expecting a pause CRT for many, many, many cycles, seasonal cycles. So we'll gyrate violently within this range, but I eventually expect this high to get taken out. Not in a 2023 model distribution, but more in a pause CRT. Alrighty, so that's natty. That is natty gas. If we're on if NFP, and we're still within this candle actually, because we're still within the 2-week candle. So that means mid-August will be distribution candle 1, then late August into September. Actually, that's kind of like the first 2 weeks of September, really. Distribution candle 2 on the 2-week, and then distribution candle number 3 is mid-September into November. So like before the midterms, I'm expecting natural gas at 3.4, 3.5. Alrighty, guys. Thank you so much for listening to